welcome to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing that we need to do is open up our brokerage platform. The one that I like to use is Tasty Trade, but feel free to use whatever you like. And of course, we are going to be writing or selling these contracts, so we need to know where we stand in the option cycle. So if we head over to the trade tab, we just want to pull up any equity. We've got BA here, that will do. And now we've got a list of expirations presented to us here, and we've got a mix of weekly and monthly expirations. We want to stick to monthly expirations for the purpose of this video. And we want to be 30 to 60 days out in time. 45 days would be perfect, but we've got to see what we can get. So if you go down the list, we've got October 18th, which is 9 days away. That's too close. We've got our next monthly expiration at November 15th, which is 37 days away. It is a little bit on the short side, but it's okay for now. We'll probably look at going to December 20th if in the next couple of days, when it gets down to about 35 days and below. So now we know we're going to be 37 days out in time. That's going to be the initial length of the contract. So you can come over to your watch list, open up the filter, and then you want to filter out anything that has an earnings event during that time period. And the reason for that is because earnings will increase volatility, it will mess up your deltas, and overall it's going to have a negative effect on your P&L. So we want to stay away from it. If you do want to do an earnings play, that's a completely separate thing. But yeah, for the purpose of this, we want to stay away from earnings, and we also want to rule out or filter out anything that has a low liquidity level, because we don't want to be paying high spreads, and we want to be able to get filled pretty easily. So with that in mind, once you've done that, you need to filter everything from high IVR to low IVR. We want to sell when Vega volatility is high, and we want to play the contraction back down to the mean, because obviously volatility is mean reverting. And once you've done that, you want to kind of just look at things that have an IV rank of over 50. Over 50 is high, below 50 is low. However, there can be some underlyings, like for example TLT with an IV rank of 47 is pretty decent. It's not too bad actually. We've got, of course, there's going to be 4 out of 4 stars on the liquidity level. It's currently trading at about $94. So I think we can have a look at TLT. We've not actually had a look at bonds up until this point, I believe. So we can have a look at TLT. It will fit quite nicely in our portfolio as well that we've got, and we already know we're going to be, November 15th, 37 days out in time. And essentially, we did just skip over this a little bit, but essentially, the way you want to find things is just, there's no real right or wrong answer. You just want to sell when implied volatility is high. Pick something that is going to fit well in your portfolio. We're product indifferent, so it pretty much doesn't matter what you pick, just as long as you follow the process methodically. So November 15th, 37 days out in time. And now we are presented with the options chain. So we've got a orange horizontal bar here. This shows you where price currently is with respect to the strikes. And we've got a vertical orange bar here, and that shows you what the expected move is of TLT over the next 37 days. So how do we make money from this situation? Well, we need to start writing or selling some contracts and bring some money in. So what contracts are we going to sell, and where are we going to sell them? There's 2 types. There's a call and a put. We want to sell one call and one put. Very simple. And where do we sell them? We want to sell them outside of this expected range, or outside of the expected move. That's going to ensure that we have a high probability of success. So I like to go anywhere between a 15 and 20 delta. So if we come on the delta column on the call side, we've got a 17 delta here at the 100 strike, which is perfect. And then on the put side, we've got an 18 delta at the 90 strike. So we've got a 17 delta on the call side, 18 delta on the put side. Overall, we've got a positive 0.28 deltas, which is basically delta neutral. That's as close as delta neutral as you can realistically expect to get for the most part. So now we've got a range. We've sold, well, we will be selling one contract at 100, another contract at 90. And as you can see, this is outside the expected move. This green bar here shows you our break-even points. Our break-even points are outside the expected move. All of these things combine lead to a high probability of profit. As you can see, we've got a pop of 72%. And if we did want to get out at 50% of max profit, we've got an 84% chance of that happening. So it's a very high probability position. And if we just visualize this on the graph for TLT, we'd be plotting price levels at 90 and 100 because that's where our short strikes are. So we've got 90 here and 100 up here. So this is essentially what the position would look like. So price is currently at 94.81. We've got our call contract up here at 100, and we've got our put contract down there at 90. So we've essentially created a range for ourselves. Okay, and what we want to happen is we want TLT to stay within this range. Specifically, we want TLT to be within this range at expiration, which is going to be 37 days out in time. As we can see here, we've had a massive bump up in IVR, which is very nice. This is a classic textbook play to get short on vol here with TLT. And essentially, this is the entire position. We want price to stay within this range. And what's the likelihood of TLT staying within this range in 37 days' time? Well, the likelihood is 72%. That's what the pop is. So what is the premium that we get to keep then? So the premium is this here. It's $1.01 times 100 shares because there's 100 shares per contract. So it's $101. So we collect this up front. As soon as the trade gets filled, we collect $101 up front. And then this trade gets put on and it looks like this. And then in 37 days' time, if TLT is within this range, then the $101 that we collect, we keep all of it and we don't need to pay any of it back. All the contracts will expire worthless and happy days. So that's that is what the position looks like. In order to open this position, the broker is going to require just over 1.4k in buying power. It is quite a lot of buying power that's required for the premium. It's not the greatest return on capital. That is partly due to the implied volatility being 18.4%. So that is another thing you want to keep in mind. You want to make sure you're getting paid a decent amount. By all means, this is a decent amount to get paid. It's not bad by any means. However, high IV rank doesn't mean high IV. They're two different things. So just keep that in mind. But by all means, this does seem to be a pretty clean position. If this did require too much buying power for your liking, $1,400, by all means you could just buy another contract a little bit further out, say 3 strikes down at the 103 strike here. So we've got a $3 wide spread here, and we can just do the same thing on the put side, and we've got a $3 wide spread there. So you've got a $3 wide spread on both sides, and what you'll notice here is the buying power requirement has massively dropped all the way down. And that's because we no longer have a unlimited max loss potential. When we buy the longs, that is essentially limiting the amount of loss that we can have. So the max loss is whatever the spread is here, minus the premium that you collect, because you never have to give the premium back. I know earlier we mentioned that you get to keep all the premium, and the reason for that is so you're shorting, right? You're shorting the contract, so you're going to have to buy it back at some point. But the premium that you collect up front never gets taken away from you. You may have to buy it back at a higher price if the position goes against you, but the initial premium that you collect stays with you. And it gets added to your cash balance in your brokerage account. So that's why the max loss is whatever the spread is minus the premium that you collect up front. because nobody can take the premium off you once it's been collected. It's like an insurance premium. Even if the insurance company pays out, you still don't get a refund on the premium that you've paid. It's collected, it's done. So it's essentially the same business model here when writing options contracts, and that is essentially how you find positions and how you can manipulate them to fit in your portfolio. Now, there is also another thing you need to keep in mind, and that is the size of your positions, because it doesn't matter what you do. If the size of your positions are wrong, then it eventually won't end well for you. So we've put together this position sizing template that's free for everyone to use. And the way it works is you enter in the size of your portfolio. Let's say if it was $15,000. Below that, you will then enter in what the current VIX level is. Say if it's 16.3. Below, everything will be automatically calculated for you. And all you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to defined and undefined risk positions. It'll also tell you how much of your overall portfolio you should allocate to short premium strategies in general. Because if you have, let's just say you've got a 100 grand account, you should not be using 100 grams worth of buying power. I mean, it seems pretty obvious, but you'd be surprised. So yeah, just keep this in mind. Keep all the information here in mind as you're building the backbone of your portfolio, and you'll be just fine long term. It's free, like I said. If anybody does want to get a copy, click the link in the description, click on the free position sizing template, and it will take you to where you need to go. We are also posting all of our trades and everything. We have got EDS Premium, so if you do want to get involved on our positions and you want to emulate our returns and things like that, by all means, get yourself signed up. The link is in the description. Click on EDS Premium. Inside, you will have access to our portfolio, so there'll be tons of positions for you to copy regardless of the size of your portfolio. There's a full course inside as well, so no prior knowledge is required. We will teach you everything you need to know. It's also a private community, so if you still get stuck, you can speak with myself directly, or you can speak with other like-minded individuals. There's a 100% money back guarantee. So once you've studied our full course and followed our trades and for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part, and right now it's £1 a month. The price will be increasing, but once you're in, you don't need to worry about that. And with that being said, I will see you guys on the inside.